Hello to all of you who are joining us for our first Outcome Matters session of 2022. My name is Anton Swanepoel. I'm the Head of Advice at MFP and the Chair of the MFP Investment Committee. It is my absolute honor and privilege to welcome you and our Momentum Investment Consulting partners to our session today. We are extremely excited to provide you with feedback regarding our house view portfolio solutions, and we trust that your confidence will continue to grow as we share information that will support your investment value proposition to your clients. But first, a bit of housekeeping. We applied for Continuous Professional Development Points, CPD, so please watch the full session and add your ID or FSP number to the CPD session so we can verify your attendance. The CPD certificates will be mailed to you after the Financial Planning Institute's accreditation is finalized. Please post your questions to the speakers in the questions and answers section, and you are welcome to use the chat function during the sessions. Our event platform will remain open, and you will also be able to receive CPD points until the end of March 2022. Please allow me to set the scene for our session today by reconfirming a few fundamental building blocks that form the basis of our house view solutions. I know that we have done this during some of our previous sessions, but in the words of best-selling author and speaker Tony Robbins, repetition is the mother of all skill. As investment advisors, you will know that investment planning is a very complex topic, and it is not an exact science by any stretch of the imagination. There are so many variables that can have an impact on investment outcomes that must be considered, such as client expectations, client interpretation of risk versus return, politics, economic functions, market sentiment, and last but not least, the effect of COVID, only to name a few. MFP faces a few additional challenges in the sense that not all our planners are equally qualified and experienced to provide quality advice to clients. And as a business, we have an obligation to provide all our planners with a rock-solid, world-class investment value proposition that will stand the test of time. In addition, from a compliance point of view, MFP had to put processes, procedures, and systems in place to ensure the suitability of advice and to limit risks to all clients across the board, our planners and to the business as a whole. To achieve all this, MFP embarked on a serious journey in July 2020 to put an investment value proposition together that is built on a sound foundation that will provide a solution in good and bad times, and one that can withstand any scrutiny by the regulatory authorities. During our initial discussions as an investment committee, we stress-tested every essential investment principle, which today forms the cornerstone of everything that we do. We have put the best minds in Momentum together to debate and to design the MFP investment value proposition. Our mission was to ensure that all the stakeholders are happy with the integrity of our solution that we offer our planners and their clients. After months of deliberation and successful implementation, I can wholeheartedly and confidently say that the MFP Houseview solutions provide a sound and sustainable foundation for every financial advisor in MFP because of the following 6 reasons. Firstly, our investment philosophy is based on sound, unshakable investment principles. Outcomes-based investing is a leading, advice-led investment philosophy that is applied by leading wealth management companies globally. Our OBI solution and philosophy meets international best practice standards and is fully aligned with our obligation to provide investment solutions to clients in accordance with their needs, objectives, and risk profile. As a committee, we have spent months to deliberate and stress test the fundamentals that underpin everything else that follows, and all the stakeholders are unified behind our investment philosophy. Secondly, we have established investment planning solutions that are consistent with our OBI investment philosophy in the form of the bucket approach to investments. We had to simplify our OBI philosophy and illustrate how it will be applied in practice. We have therefore used the principles of the OBI philosophy and broken it down into different underlying components so that clients will be able to understand how our philosophy will address their individual needs and objectives. Thirdly, we have designed our investment portfolios in accordance with our investment philosophy and investment planning solutions. Our investment advice Houseview portfolios, which were designed by our investment specialists, are fully aligned with our clients' needs and objectives. This required specialist input from our investment professionals at Momentum Investment Consulting, backed up by actuarial, CFA, and portfolio management expertise that goes far beyond our investment planning responsibilities as advisors. In the fourth place, we know that investing money is never a once-off affair. There is a need for ongoing investment management to ensure that the portfolios remain aligned with the relevant client outcomes. Again, this function goes way beyond merely assessing portfolio returns over the last 3, 6, or 12 months. This function requires a deep insight into investment markets internationally and asset class valuations in the context of the desired client outcomes that must be achieved. We have deliberately decided to partner with Momentum Investment Consulting to ensure that our planners are not exposed when selecting funds and taking responsibility for the ongoing management of the underlying portfolios. In the fifth place, we know that it is vital for you, our planners, to provide insightful feedback to your clients on an ongoing basis. This is one of the reasons that all planners who provide investment advice should attend these sessions. Outcome Matters is the platform that provides relevant information that will enable you to respond to your clients' investment-related inquiries with insight that goes deeper than the last quarter's performance tables. Last but not least, we have aligned our investment planning process with the MFP 10-step process of professional client engagement for all MFP's advice and product solutions. This process is live on VIA and now well established within MFP. This process is fully supported by the MFP client records of advice that ensures that transactions are accurately accounted for. Colleagues and friends, thank you for joining us for today's session. We sincerely hope that you will enjoy this session as much as we have enjoyed putting it together for you. Welcome.
Good day, and welcome to our first quarterly update for the Momentum Focus Fund of Funds. I'm Jaco de Jager. In today's session, we want to take the opportunity to give you a brief overview in terms of what transpired in markets over the last quarter and what was a phenomenal 2021. Later on, I'll hand over to my colleague and co-portfolio manager, Ronnie Bornman, to take you through our current thinking in terms of both our fund positioning and fund delivery over the past year. As always, we trust that the updates will assist you in having those meaningful feedbacks with your clients in the coming days and weeks. If 2020 was a year to forget, then 2021 will certainly go down in history as a year to remember. Not only for the lingering effects and impact from the pandemic, but also a year that saw markets climb to new record highs. With the unprecedented amount of stimulus injected into economies, we saw a recovery in global growth and many asset markets moved from recovery to expansion, and they ultimately surpassed their pre-pandemic levels. There are, however, some dangers lurking in the waters. While COVID-19 dominated headlines, multiple concerns have also come to the fore and have spooked investor sentiment at various points in the second half of last year. Some of these concerns are related to changing focus and regulatory restrictions of the Chinese economy, whereas others more directly attributed to inflation, which is proving to be more stubborn than first anticipated. Current global risk factors, such as the Russian-Ukrainian tensions, can also not be ignored. As mentioned, markets were buoyed by positive developments, including strong corporate earnings and increased consumer demand. Developed market equities were notably stronger compared with emerging markets, with the MSCI Emerging Market Index falling by 2.5% in dollar terms. Value stocks began the year strong as economies reopened and interest rates were rising, while growth stocks rallied later in the year. Fixed income markets experienced more tepid returns, and credit spreads ended 2021 at levels narrower than pre-pandemic levels. The South African Reserve Bank hiked the repo interest rate by 25 basis points to 3.75% in November, while CPI rose by 5.5% year-on-year, and South Africa's GDP growth slowed to 2.9% year-on-year in quarter 3, contracting by 1.5% on a quarterly basis due to the harsh impact of the July riots. Forecasts show a consensus of around 5.1% growth for 2021, falling to around 2% in 2022. The economy may face more headwinds, such as the continuation of the coronavirus pandemic, slowing global growth, rising interest rates, and further power constraints, and of course the possibility of lower government spending. Given the strong economic backdrop, we witnessed exceptionally strong returns from especially growth asset classes in 2021. Markets were off to a strong start, but sentiment waned somewhat in the light of the Chinese government's regulatory clampdown, as well as a more hawkish stance by the US Federal Reserve. The final quarter of 2021 proved to be a much more successful one for risky assets, despite increased volatility. The identification of the Omicron variant and coupled with more geopolitical tensions. Negative emerging market sentiment spilled over into quarter 4, with the MSCI Emerging Market Index, of which China makes up approximately half, severely underperforming developed market equities. Domestic equities, along with domestic property, gained more than 8% in the last quarter, ending the year 27% and 37% stronger. On an inflation relative basis, this has lifted the medium-term equity returns, with the asset class returning 6.8% above inflation over 3 years and 2.8% above inflation over 5 years. Domestic property, despite a very strong 2021, is still in negative territory over 3 and 5 years, and therefore significantly behind inflation. The ongoing inflationary concerns saw inflation-linked bonds continue their strong run, with a healthy return of 5.3%, while local nominal bonds offered a respectable 2.9%, followed by cash that returned a mere 1% over the last 3 months. With the exception of negative real returns over 1 year, cash, bonds, and inflation-linked bonds all delivered positive real returns over the medium and longer term. The rand weakened by 6.2% during the quarter, bringing the MSCI All-Country World Index return to a very pleasing 12.6% in local currency terms. Currency weakness also benefited global bonds, while global property continued a very strong showing, up nearly 17% in absolute terms. The phenomenal returns of 2021 have certainly lifted short to medium-term asset class returns. If we look at asset class returns on a 3, 5, or 10-year annualized basis, we can see that relative to inflation, market returns for many asset classes are still below our longer-term real return expectations. Fixed income assets have largely been on par, and in certain instances ahead of these growth assets, indicating that markets has not been particularly rewarding for the risk-taking investor. Global growth asset classes have fared significantly better in this regard, but within a Regulation 28 constrained portfolio, the impact of this is moderated by the maximum allowable allowance. The impact of this low real return environment is evident in the next chart, which, as we have shown before, has seen a marked downturn trend in returns for the average ASISA multi-asset class fund, irrespective of risk profile. There has been some recovery since the bottom in 2020, but elevated real returns from multi-asset class solutions remains elusive and difficult to achieve. This is also evidenced in the slide on screen. Focusing on the ASISA multi-asset high equity category, we consider the range of outcomes of all funds in the category, measured over a rolling 7-year basis. It is noticeable that fewer and fewer funds have been able to achieve a CPI plus 6 return consistently, and many funds have actually struggled to keep pace with inflation in this market environment, which has not rewarded risk assets. The recovery in financial markets have been very relevant for our solutions, as we experienced an exceptionally strong 12 to 18 months post the COVID outbreak. We are also seeing a similar trend emerging from the market. While it explains the turnaround of multi-asset class fortunes, we are not out of the woods just yet. Before handing over to Ronnie to give you more of a solution-specific perspective, I wanted to briefly stand still on the concept of time in the market versus timing the market. We hear this often, but there are a few slides that illustrate this as well as the standard cumulative graph. Starting from a base in early 2012, you will notice the gradual and sometimes gentle pace at which we and the market could grow client capital. The pace slowed somewhat in 2018, when equity markets returned a negative 10% and property lost 25%. But the impact and severity of the COVID sell-off threw the cat amongst the pigeons, and clients had to resist the temptation of taking action, unnecessarily changing their long-term investment plan and strategy, or at worst, sell out of the market altogether. As we know now, the recovery was swift and strong, and returns generated from an established base saw us reach new highs. Again, this illustrates the need to be patient and focused on your longer-term investment strategy or savings plan. On that note, I'm going to hand over to Ronnie, who, alongside myself, is responsible for the daily management of these solutions, the formulation of investment strategies, and importantly, how we navigate these choppy waters. Over to you, Ronnie.
Thank you, Jaco, for that comprehensive overview of what transpired over the last quarter and 12 months. And welcome to all our advice partners dialing in today. As outcome-based investors, we follow a true north, also known as our strategic asset allocation for each fund. This strategic asset allocation is carefully modeled and derived using several inputs, including risk appetite, investment term, probability of success, and investment objective. While we do take tactical positions and constantly adapt to the prevailing market conditions, we always have the strategic point of departure as well as the risk objective in the back of our mind. As we saw in the 2020 environment, we stayed true to our philosophy, and the result was that we participated handsomely in the recovery post-COVID, as the next slide alludes to. By not de-risking too far, we were able to capture the upside markets offered in 2020 and 2021. This has seen our funds offer up significant double-digit returns, and also, while not an explicit objective, very peer-credible returns in the 20 months since the onset of the pandemic and the initial sell-off in markets. The Focus 3 Fund of Fund and Focus 5 Fund of Fund solutions outperformed the average manager by more than 6% during this time, while the more aggressively constructed Focus 7 Fund of Fund delivered returns in excess of 10% over the same period. Our 2021 experience saw the funds add double-digit returns ranging from 16.4% up to 24.3%, depending on the risk profile of the fund. These returns are ahead of both the CISA peer group averages for their respective categories, but also ahead of the inflation-linked targets and strategic benchmarks over this period. The strategic benchmark is the return achievable if you are able to invest according to our strategic asset allocation in a market-linked index fund with zero costs. Outperforming this benchmark indicates value generated by the fund manager's active tilts in the portfolio, as well as the underlying fund's alpha delivery above their respective benchmarks, all on an after-fee basis. The next slide drills down a little deeper into the total impact of the decisions we've made and the mandates we allocated to, and how each of these two components contributed or detracted from performance over the past 12 months. The takeaway here is that both the decisions we made to over and underweight specific asset classes, as well as some of the security selection from our partners, have contributed to performance. But more on our positioning a little later. Now, as discussed earlier, exceptionally strong and competitive short-term returns, assisted by the market beta, has also alleviated some of the pressures of our fund's medium-term delivery, as is undoubtedly also the case for other multi-asset class funds in the local environment. As noted by the color coding, all our funds are comfortably ahead of the strategic benchmarks, and over the medium to longer term, we are seeing returns track much closer to the respective peer groups and even the lofty inflation-linked objectives. Now, turning our attention to the funds underlying the fund-of-fund range and comparing the net return for each fund to their gross benchmark, we can get a sense of what has worked well and where there's room for improvement. Performance delivery of the domestic equity component versus benchmark and the peer group has been exceptional over all reporting periods. Our listed property allocation is positioned for the longer term with a bias to higher quality companies. The fund has managed to track close to the benchmark, which has been very indiscriminate in re-rating all of the current benchmark constituents. We have also been very pleased with the swift and strong recovery of our flexible fixed interest fund post the sell-off in 2020. The fund is positioned with a long duration and set to partake in the looming interest rate hiking cycle. And lastly, notable is our global equity component, which despite very peer-credible double-digit absolute returns have lagged the index given the style and medium cap bias relative to the mega cap tech-dominated index. The fund has participated significantly in the value rally seen in the early part of 2021. Now, the domestic equity blend we have constructed in the fund of funds has been a star performer in the range. This blend is designed to extract alpha from deliberate exposures to three distinct risk factors, those being value, quality, and momentum. This style allocation drives our manager selection process, and each manager in the lineup is included to fulfill a specific allocation towards this overall blend. Of course, we do not expect them all to perform or be in favor with the market cycle at the same time. But this diversified approach does lead to a more robust delivery through all market cycles. As the saying goes, the blend is your friend. If we now take a look at the fund returns of this blend, we can see the diversification of the managers and strategies in action. For example, Fairtree has been one of the top, if not the top performing equity manager in the local market over the last few years. But so too has come under pressure very recently given the impact of the Chinese government's regulations as it relates to resource stocks in the local market. This strategy has, however, dovetailed very well by complementary managers in the sense of 91, M&G, and Truffle over the 12-month period. The market has been less kind and did not reward the quality risk premium or style over the last while, impacting managers with this attribute off focus in their portfolio constructs. Looking at our current fund positioning now, we believe that markets may be more volatile and returns may be harder to come by in 2022 compared to the last year. Much depends on the projected path of tapering, inflationary pressures, interest rate hikes, and now geopolitical tensions. However, we expect supply chain bottlenecks to ease somewhat and economic growth, while slowing, to still be intact. To that end, we still favor local and global equities, and the real yields on offer from local fixed income assets is undeniable, with some room to spare should we see further interest rate hikes. We are cognizant of the challenges that local property may face in the current local economic climate in South Africa, and are maintaining a slight underweight to this asset class. Local cash and global bonds remain unattractive given current yields on offer, and we are more optimistic about global property in light of easing lockdown regulations and a return to some normality. If we compare our funds positioning to that of the ASISA multi-asset peer groups, we see that our funds are reasonably similar positioned from an overall growth and global asset exposure perspective. Of course, our Focus 7 fund of fund is our most aggressive solution in the range, and by design, it is more aggressive than the peer group. So while we do not set out or manage the funds to look similar to peers, this view can be helpful in setting or managing client expectations or comfort levels. Of course, where we do differentiate the most is how we allocate within that growth, defensive, and global allocation of the funds. Given our current active positioning within the funds, it is worthwhile to note that there's a level of risk associated with each solution, commensurate with the level of expected growth. As outcome-based investors, we like to define this as the expected level of capital at risk. Each fund is designed to take on a certain level of risk in order to generate returns. The higher the return, the more risk naturally, and vice versa. This level of acceptable risk is shown in the pink bars. In the yellow bars, we measure the predicted level of risk currently taken in the fund given our current positioning. And while this is a good statistical measure of risk, it is not a guarantee, as there are always risk of tail events, as we saw in 2001, 2008, 2011, and indeed 2020. We are, however, comfortable with the current positioning relative to the objectives of each fund. Overall, we are therefore very pleased with the performances and positioning of the funds over the recent 12 months, and the impact it's having on the longer dated returns and competitiveness. As always, we remain focused on the ever-changing market dynamics and purposeful asset class, strategy, and mandate diversification of the funds. Hopefully, we have given you some insights that will help you navigate and articulate this recent experience with your clients and help them to remain invested for the best opportunity to achieve their investment outcomes.
Definitely. Thank you very much for the insightful commentary, coupled with the hard work and dedication to these solutions, Ronnie. As we kick off another year, I trust that today's overview has been informative, and we thank you for your time. Until the next time, take care.
Where are we now? Some of you may recall this picture from the previous Outcome Matters session, where I closed asking the same question. At the time, we spoke about the risks facing us and their potential threats to markets, particularly those areas who were almost priced to perfection with very demanding valuations. Among these risks was the persistence of higher inflation, and with it, the possibility of sooner than expected rate hikes. With the latest US inflation print coming in at 7.5%, the largest we've seen in roughly 40 years, we've seen the Fed turn significantly hawkish, with expectations of rate hikes as early as next month. I think it's safe to say that those risks are now a reality, and consequently, we've seen sharp sell-offs in January in those same parts of the market we were most concerned about. However, this chart remains relevant today, as there are still risks to the interest rate outlook, among others, and valuations remain stretched in some parts of the market. But our job as portfolio managers is one of balancing risk and return, in line with the portfolio objectives. And as you will see today, our risk-cognizant and diversified approach to investing has helped navigate this volatility, and we believe will continue to help navigate the turbulent times we foresee for 2022, with the ultimate goal of providing your clients with as comfortable an investment journey as possible and keeping them invested. Looking back on 2021, it's fair to say that local investors were given some reprieve after 5 forgettable years in investment markets. While investor sentiment ebbed and flowed off the back of a number of risks such as inflation, a worrisome Chinese economy, and a number of COVID-19 variants, bringing with them heightened volatility in markets, corporate earnings remained resolute, supported by the continued recovery in global growth, owing to stimulatory monetary and fiscal policies. As a result, growth asset classes, both locally and globally, delivered 4 consecutive quarters of positive performance in Rand terms, with Q4 being particularly strong. Since launching these portfolios 9 months ago, we've seen double-digit returns across all but 2 of our primary asset classes. Listed property, both locally and globally, were our best performing asset classes over this period, delivering returns of approximately 30%. They have been significant beneficiaries of the reopening of the global economy. This was closely followed by global equity, which delivered returns of around 23%, supported by around 8% of Rand weakness. Last among the growth assets was local equity, who delivered 13% over the 9 months, which is significantly lower than its full year return of 27%, highlighting the massive value rotation experienced in markets in Q1 following the successful rollout of vaccination programs globally from November 2020. On the defensive side, the fears around global inflation, tighter monetary policy, and global growth drove bond yields higher, and as a result, dollar returns were marginally negative for global bonds, although this was completely offset by Rand weakness. Local bonds, on the other hand, delivered strong returns of around 10% as the yield curve flattened, with the high starting yields also contributing significantly to returns. Finally, cash delivered absolute returns of around 3%, although real returns were still negative, with inflation around 4% for the period. Diving deeper into local equity markets, we can see that financials were the best performing sector for the 9-month period, despite being the worst performer in the last quarter. Resources, on the other hand, shook off a terrible Q3 to deliver an impressive 21.6% return in Q4, supported by a rally in gold and energy shares as global inflation fears and geopolitical tensions rose. Finally, industrials delivered decent double-digit returns over both the 9-month period and the last quarter, despite the significant pullback in the Naspers and Prosus share prices, with the sector benefiting from the strong performances from the likes of MTN and Richmond. From a market cap perspective, large caps rallied significantly in the last quarter, although the 9-month return for both large and mid caps was eclipsed by small caps, which delivered just over 30%. These stark differences in the 3 and 9-month numbers highlight 2 important benefits of our approach, which we will see in more detail later today. Firstly, the diversified strategies we employ in the local equity space allows us to capture the upswing across all areas of the market at the different times. And secondly, our use of credible boutique managers allows us access to the full spectrum of local equity markets. Looking now at global markets, we have seen stark differences in the performance of emerging markets versus developed markets over both the quarter and 9-month period. Emerging markets have been significantly impacted by the underperformance in China, whose markets have been impacted by the drastic policy and regulatory shifts, which have seen certain sectors such as property, tech, and education being decimated. While this has certainly impacted our portfolios, our prudent allocation to emerging markets has mitigated this to a certain extent. Furthermore, we remain constructive on the outlook for emerging markets, which we'll unpack in a bit later. Turning to the MFP Focus model portfolios, this slide shows how the portfolios have performed relative to their benchmarks and peers since their launch in March 2021. It is important to note that as these are model portfolios, we have used the most appropriate peer group according to where these funds would appear if they were registered collective investment schemes. Across the board, the portfolios have taken advantage of the positive economic and market backdrop, with all portfolios comfortably ahead of their benchmarks and peers. We must, however, remember that this is a very short time period where markets have been particularly strong, and as such, we believe it is important to manage your clients' future expectations. Looking closer at our returns, this chart shows how the portfolios would have performed since their inception, assuming we invested passively and for free according to our strategic asset allocations. All local asset classes, barring cash, have been significant contributors to performance, while global equity was also a significant contributor. Just to remind you that the contribution from local bonds is much higher in the Focus 3 portfolio, given its more conservative nature and therefore higher allocation to local bonds. Similarly, as we move up the risk spectrum, the contribution from our growth assets increases. This slide highlights the importance of asset allocation. Comparing these figures to the portfolio returns, we can see that this is by far the biggest driver of returns, and it is for this reason that we ensure that these strategic asset allocations are optimized according to the objectives of the portfolios and hence your clients. This table gives greater insight into our tactical calls. Overall, our tactical calls marginally detracted from performance across the portfolios. The primary detractor across the portfolios has been our overweight position in local bonds, despite the asset class delivering compelling real returns. This has, however, been offset by our overweight to global equity, where possible, as well as the underweight to local cash, which has delivered negative real returns over the period. Finally, this table shows the top and bottom contributors to manager alpha. Starting with our contributors, despite this correction in local bonds in September, Momentum SA Flexible Fixed Interest remains a strong contributor to returns, owing to its outperformance in Q2 and Q4, as the fund benefited from its long duration position. A-Lit Equity benefited from its value and small cap bias, as well as its offshore allocation, while Blue Alpha, who we will hear from in our panel discussion later today, also benefited from its exposure, as well as its deliberate shift towards high-quality cyclical stocks. Our most notable detractors are both within the equity space, namely Fairtree Equity on the local front and Momentum International Equity on the global front. We will hear from both of these managers later today, so we will hear straight from the horse's mouth what have been the main drivers of their performances. This table shows our positioning at a mandate level. This means that the actual asset allocations of the portfolios may differ slightly as a result of managers' allocations to other asset classes, such as cash or global assets. Looking ahead, while we expect that returns will be harder to come by in 2022, we remain constructive on the outlook for growth assets, both on an absolute and relative basis. In absolute terms, we believe growth assets will be supported by global growth, which is expected to remain above trend, while on a relative basis, despite stretched valuations in certain pockets of the global equity market, we believe global bonds remain more expensive, with their outlook further dented by the expected rise in global yields as we move into a new market regime of rising interest rates. However, given the risk of a stickier inflation environment and the potential for a steeper rate hiking cycle, along with the rising geopolitical risks, we are prudent in our global equity allocation. On the local side, we remain constructive on local equity markets, whose valuations are far more compelling than the global space. We do, however, believe returns locally will be driven far more by re-rating than earnings growth, which will therefore require catalysts to unlock this value, either from a macro level or within the companies themselves. Finally, we remain constructive on the outlook for local bonds. While we expect rising bond yields globally, which should increase volatility on the local front, we believe our markets have already priced in a significant risk premium, which we expect to absorb some of this volatility, as was the case in January. Further to this, unlike the global space, our starting yields are extremely attractive, which we feel compensates for the potential volatility. To close with a quote, "Success is a journey, not a destination. The doing is often more important than the outcome." This quote by Arthur Ashe resonates with investing for me, although I would perhaps rephrase it to say the not doing. Looking back at investment markets for 2021, one can perhaps say with a smile that returns were fairly easy to come by. After all, growth assets locally and globally delivered positive returns in all 4 quarters. However, when we look at the journey investors faced, 2021 will certainly be remembered for the heightened volatility, as sentiment ebbed and flowed off the back of high inflation prints, the start of tapering in the US, an increasingly hawkish narrative from the Fed, the emergence of new COVID-19 variants, and an increasingly worrisome Chinese economy, who had massive regulatory shifts. We saw different regions, sectors, and styles move in and out of favor, often with massive differences in returns, as illustrated by these 2 charts. The temptation to cut your losses or chase top-performing sectors can certainly be forgiven in this environment, although, as we've seen too often in the past, these knee-jerk reactions tend to cost investors dearly. In moving to a new regime of rising rates, along with the rising geopolitical tensions, it is likely that 2022 will offer the same level of volatility, if not more. The primary defense we can offer you and your clients in this environment is our diversified and risk-conscious approach to managing these portfolios, which we believe will continue to reward investors who weather the storm and stay invested. One of the core capabilities that supports our investment proposition is our world-class manager research capability. This capability is foundational to the final step in our outcome-based investing process. Once we have arrived at the optimal strategic asset allocations and have identified the investment strategies we want to be exposed to, the next critical step is finding the most appropriate mandates or managers that can execute these strategies. Headed up by Jean Badenhorst and supported by Tatiana Raunich, our manager research team has over 45 years investment experience. This experience gives us institutional memory and allows us to track the movements of investment professionals across the industry, meaning that certain boutique managers that are perhaps unknown to the market are very well known to us. We also have very wide coverage of the market, with around 80 investment managers and 250 different mandates, giving us the best chance to find the best suited mandate for the strategy we are targeting. Our research process is both qualitative and quantitative in nature, and we try to understand whether the qualitative aspects that we hear from the managers are seen in the quantitative outcomes. To do this, we spend a considerable amount of time in understanding a manager's core philosophy and process to ensure that what we expect from the manager over time is realized in practice. We also employ a range of tools which give many unique perspectives on these quantitative outcomes. And while the investment side is very important, an equal amount of time is spent on operational due diligences, just to make sure that we are not exposed to any unintended risks that may arise in executing these mandates. All of this comes together and allows us to build risk-conscious, diversified portfolios which provide your clients with a more palatable investment journey to reach their investment objectives. Today, you'll see firsthand part of our manager research process, where we will be chatting to 3 fund managers within our universe. A very warm welcome and thank you to everybody who has joined us for this session, where we will be lifting the bonnets of the MFP House View Solutions and chatting to some of the underlying fund managers to get their thoughts on the year that has passed and, of course, what lies ahead. I'm Dean D'Souza, Portfolio Manager of the MFP Focus Model Portfolios, and I have the privilege of being joined today by Walter Jacobs, Chief Investment Officer of Blue Alpha Investment Managers, Cor Boyson, Equity Portfolio Manager at Fairtree Asset Management, and Robert White, Equity and Multi-Asset Class Portfolio Manager at our very own Momentum Global Investment Management, or MGIM as you may know it. Our goal today is to give you first-hand access to this panel of experts and provide you with deeper insight into the range of diverse strategies we employ in our solutions. Please feel free to pop any questions you may have in the Q&A section. I thought we'd start off with a retrospective on 2021 and maybe just get some insights into how your funds have performed. Starting with you, Walter, can you maybe take us through your performance over the past year in the context of performance of quality as a style, and perhaps touch on the shift from defensive to cyclical quality in your fund? Why the change, and how has that benefited your performance?
When you compare us to quality, our performance is actually done pretty well relative to a quality benchmark. When people think about quality, they typically think it's a homogeneous style, but we see quality as having 5 distinct buckets: cyclical quality, economically exposed quality, defensive quality, low volatility, and cheap quality. And what we attempted to do was to get more exposure to the economically sensitive bucket of quality and the cyclical bucket of quality. And that has really helped performance quite a bit versus a defensive quality type bucket. Examples of switching out of Vodacom into MTN, AVI into something like Woolworths, where they're much more geared to a recovery in the economy while still retaining the quality features of a stock.
Thanks, Walter. Segueing to you, Cor, your equity fund experienced its first calendar year of underperformance, albeit after very strong alpha years in 2019 and 2020. Were you surprised at all by your performance? And maybe if you can touch on your performance in the context of your particularly bullish view on PGMs.
Yeah, 2021 wasn't our greatest year. I guess after 9 good years, at some point we will be underperforming. We shouldn't have been too surprised in hindsight. We started the year with a very strong PGM position. The basket price looked very strong. And then we didn't foresee the semiconductor shortage, which caused the second half of the year global vehicle production was dropped significantly by most of the vehicle manufacturers. As a result, the demand for PGMs fell, and we had a mini collapse in the PGM prices. So the PGM counters didn't do that well, although they did give us a positive performance. And to make things worse for us, a couple of other big stocks that we had very little exposure to did very well, MTN being one of them, Richmond and Sasol. We always struggled to make investment case for Sasol. Those 3 stocks did very well, so the benchmark did quite well. And we had, in hindsight, way too much PGM exposure.
Thanks, Cor. And maybe finally to you, Rob, on the global space. The Momentum International Equity Feeder Fund, had a fairly decent year in absolute terms, although it lagged global equity markets. Why was that?
Thanks, Dean. So, of course, equity markets had an incredibly strong year. The S&P was up close to 30%, and generally world equities were up about 20% or so. And although we did capture a good proportion of those absolute gains, as you mentioned, we did lag broad equity markets, and that's really because of the success of the so-called kind of TINA trade. There is no alternative to equities, and of course we don't just buy equities in the fund; we supplement them with other asset classes too. I think we did relatively well to avoid government bonds, which of course had their worst year this century in 2021, and they continue to be challenged this year. And instead, we've owned property, infrastructure, and credit to complement our equity positions. And again, these made us money, but they lagged the very strong equity markets, with the exception of property, which had an exceptionally strong bounce from the difficulties experienced during the pandemic. But generally, a positive for us in terms of our relative performance has been our style diversification. We invest across growth, value, and quality styles, and we allocate to both traditional discretionary and systematic managers. And 2021 was the first year that the MSCI Value Index actually outperformed MSCI Growth since 2016. And the fact that we had exposure to some of these more cyclical value sectors rather, such as financials and energy, helped our portfolio. And that comes through when you look at the top contributors, which come from a real mix of names, like some of the previously beaten up retailers like Macy's and Signet Jewelers, and also including some of the larger cap tech names such as Microsoft and Alphabet too.
Thanks, Rob. I'm going to stay with you here. And can you maybe take us through how your view on the world has changed over the last sort of 12 to 18 months? What is worrying you now, and perhaps what role do you expect these alternative asset classes to play in your fund over the next year?
Yeah, that's an interesting question. I think really, 18 months ago, if you go back that far, the world was in a very dark place. And the principal economic concerns were things like, saving businesses from going under, and obviously protecting public health being paramount, and preventing mass unemployment with a lot of extraordinary interventions from governments and central banks. And there was uncertainties everywhere in terms of the virus. We didn't have a vaccine yet. But of course, a lot of those risks are largely behind us now. And we certainly think that the success of the vaccine program has accelerated that. And it's not one of the main risks that we sit and talk about in our monthly meetings. In fact, the primary concerns really seem to be the opposite to 2020 in a number of ways. Pent-up demand has been being released, and supply has been struggling to keep up. And generally, there are a lot more assets that look fully valued. On top of this as well, you've got central bank support being withdrawn, and the level of government indebtedness now means that fiscal support will likely be less forthcoming in subsequent years. And that's got the potential to reverse some of the liquidity boom that we've seen and cause rapid rises in fairly speculative assets like cryptocurrencies and the like. And again, there seems to be more risks on the horizon for investors. And ultimately, we think returns will be generally harder to come by in the very near future. But they're still on the table, and you just have to be more selective about where to allocate, making full use of diversification across various styles and regions, as we strongly believe. But we do think this is pretty attractive for active managers generally. There's lots of disparities in the market in terms of valuation, and we think that the pandemic has brought some interesting new structural changes to the way we live and work, which will be with us permanently. Just from day-to-day examples, we're all working from home more readily, and doing things like online grocery shopping, and these new habits that we've all embraced do create new examples. And one that we're using in the funds right now is particularly relates to infrastructure. So there's a great, there's a vast investment universe in the UK in terms of the investment trust universe, which gives us access to a lot of closed-ended fund vehicles, which are still liquid and trading on exchange, but they enable us to access areas like digital infrastructure, so where we can invest directly into or directly via trusts into the likes of kind of fiber optic cables and data centers, and we're really plugged into a lot of these new trends that are emerging from the pandemic, and these sorts of assets often have inflation pass through in their contracts, and really give us good diversification looking forward.
Excellent. Thanks, Rob. Walter, on your side, we've seen quite a significant pickup in SA Inc. exposure with a bit of a marginal reduction on the materials, while your Rand hedge positioning has remained fairly stable. What were the sort of key drivers of this change, and what are the key risks that you are mitigating against with the shift in your portfolio?
Yes, we think that SA Inc. has got a good opportunity ahead of it. As was mentioned, the market continues to open up, economies continue to normalize, and SA has lagged some of this. So as the South African market and economy starts normalizing, things like city large holdings where business travel starts kicking in, presents an opportunity. And we're continuously looking for companies that even pre-pandemic had a good business model, generated good returns on capital, and we're confident that as the economy opens up, those companies will come back and once again generate good return on capital and ultimately generate good returns for shareholders. Similarly, on the clothing side, companies like Pepkor, Mr. Price, all primed for a reopening of the economy, continued going back to work, and even employment within the corporate sector hasn't recovered, and we think that that's one of the areas again that will recover as we go forward and will provide support to these businesses.
Excellent, thanks, Walter. Cor, on your side, we obviously heard from Rob. He touched on sort of the global inflation. Given the strong macro input in your process, what are your thoughts on inflation, and what reaction do you expect from the Fed? Do you think they have this under control? And what are the positions you are building your portfolio to address these concerns?
Yeah, so inflation has been a bugbear of us for a while now. So we've been highlighting inflation since probably middle of 2020, end of 2020. We've become more and more convinced that inflation is a real problem. The market seems undecided on inflation. We think the Fed is behind. We think this is very similar to what we've seen in the 70s. We've got a very tight labor market, surprisingly. We've got pent-up demand, as mentioned. Most supply companies, in terms of mining suppliers, haven't spent capex for a long time. We've had these disruptions, bottleneck disruptions, that will sort itself out. But I think the supply chains are very tight. We think we've got permanently high energy prices going forward. There's a tight labor market, as I mentioned. And we are of the view that inflation is not going back to 2 or even 2.5%. We think it's probably going to be higher than that going forward. And there is going to be a transitionary period where the markets need to adjust to that. Bond yields need to adjust to that. Interest rates needs to adjust to that. And that's going to cause quite a bit of volatility in global markets specifically, especially highly rated assets. And we've changed the fund to protect for that. So started to buy more defensive companies, more energy into the fund. Those commodities that gives you inflation hedge. We've also got a healthy slug of gold exposure in the fund as a result.
Thanks. Well, I hope not exactly like 1970, because those are some quite trying times. Rob, you've had an overweight to EM for quite some time now, which has largely been dragged down by China. Just your thoughts on China going forward?
There was certainly a headwind in 2021 because, of course, you had the issues with a whole raft of regulatory changes and generally the controlled implosion of the property sector, if I can put it like that. But what we find now is that obviously a lot of what's going on in the property market is certainly priced into kind of debt markets. We're seeing a lot of these companies priced for default. And actually some pretty chunky yields on offer for those willing to take that sort of risk. But as far as equity markets go, we obviously saw big falls, particularly in areas like education, but also in the big tech names, which suffered from the regulatory clampdown. And of course, they introduced a lot of uncertainty into that path of future earnings, which is a big part of the valuation for the likes of Alibaba and Tencent and so forth. But really, if you take a step back and you look at the market in general, China's it's still likely to grow about 5% in 2022, which is pretty impressive for an economy that size. They're set to overtake the US in the coming decade or so in terms of their economic size, and they've really got big ambitions in terms of what they want to do with their currency and their economic clout as well. So, the China story there is certainly a long-term one. There have always been risks around the China equity market, and you do get paid for those risks. You see a lot of stocks trading in the market at discounts to their DM peers. I mean, just look at the FANGs and the big tech in the US, for example, and some of the extensive valuations that they trade at. But really, what I think, you've got that structural story over the long term, which I certainly believe is still there. But also, there's a more cyclical story there as well. So China's actually on a different inflation path to the rest of the world. I think their latest CPI print was at 0.9%, so very different from the US, at, above 7%. And they've actually been easing to offset some of the problems in the property sector, as they've seen this slow down, and they've been easing the monetary policy. And they've got plenty of levers to pull if they need to do that further as well. So I think the structural story there is there, and I think the shorter term kind of cyclical policies are kind of in the right place for a good year in 2022. Of course, there's caveats there. Emerging market equities typically tend to be higher beta than developed markets, and if we do enter a more challenging period, emerging market equities could be at risk. But generally, we think that if we balance the portfolio and we take limited exposure in these areas, we can get good returns over the long term.
Thanks, Rob. Yeah, I'm hearing from you that sort of counter-cyclical Chinese impact compared to the rest of the globe. I mean, Cor, would you agree with those views? And perhaps, can you touch on what that means for your portfolio and the opportunity that this sort of counter-cyclical environment in China presents for South African equities?
Yeah, I think we agree very much with Robert. So we see quite a different situation in China. Inflation is not a problem; they are stimulating. We've got the opposite situation in the US, and also pleasingly, the valuation levels generally in EM, especially also in China, is much cheaper than DM. The tech stocks have derated significantly last year due to regulation. This is an election year; it's going to be much more stable in China. So we've actually increased our exposure to Tencent through Naspers and Process. It is offering exceptional value into still a growth stock. And also last year, what Robert mentioned is the fact that they also curtailed steel production towards the second half of last year, which also had an impact on iron ore. So we think with a stable economy in China, the tech stocks can do well. Also, commodities should be stable. Commodity prices are very healthy at current levels, so that as long as they're not that volatile, that also should give us good returns. And then with energy again in China, thermal coal is a big consumer. They're a big consumer of thermal coal, and it's become a dirty word, thermal coal, but it could actually give us very, very good investment returns over the next couple of years.
Thanks, Cor. Walter, you touched on this earlier that SA equities are showing value relative to the global space. We obviously had the earnings rally last year, and now obviously for this year we're looking at re-rating to trigger some of those returns. What are the catalysts that you think are necessary to unlock this value, and how realistic are they? And maybe if you can touch broadly on whether they should be sort of internal catalysts versus maybe more broader macro catalysts.
Yeah. We think it should be internal catalysts. I mean, we agree that globally valuations are stretched, and even though it's come off, we don't think it's over. With rising rates, rising inflation, there could potentially still be a sell-off. But having said that, the focus is on local equity, and companies like MTN, and although it's not a local company in terms of where it does business, Richemont still provides really good growth opportunities. As far as local goes, we do think that the SA consumer has been through an extremely tough period, not just in the last year, but over a number of years. And whether you look at things like savings to personal disposable income, that has actually been rising. So telling you that consumers are not spending, they're very unsure about the environment. If you look at consumers' contribution to GDP, that has been declining for a good part of 7 years. And if that confidence can come back into the consumer, there is some real opportunities within that space. So we are overweight clothing retail. We are overweight things like ShopRite. because we do believe that apart from them being really high quality businesses with very high return on capital, some of these companies are also not just sitting and waiting on the macro, but are doing things to better the operations themselves. Example, ShopRite got out of most of its problematic Africa areas. And you've seen that since that renewed focus on the business in South Africa and doing very well on the online side, expanding in clothing and in pet food. So really, we like businesses that don't just also sit still and wait on the macro, but actually do things themselves to move the business forward.
Thank you, Rob, Walter, and Cor. If I can maybe just sort of summarize what we've discussed today. Obviously, the first point is that volatility is expected to remain quite high sort of going into 2022, with returns obviously much harder to come by. We are clearly moving into a new regime globally, with rising interest rates and inflation presenting a problem, particularly in the developed market space. And therefore, we're hearing that you need to be a lot more selective about where you place your money, and that, diversification across sectors or styles in the case of, Rob's portfolios is certainly going to be key. If we can maybe just close across the panel, and I'm going to start with sort of you, Walter, then Cor, and if we'll go to you, Rob, to close. Is there a particular quote or a book or a podcast that sort of or that is currently sitting sort of rent-free in your head that you think, the audience, would benefit from listening to?
Yeah, for me, it's not a podcast or something per se, but it's work from Michael Mauboussin. I've worked with him when I was at Credit Suisse. He's obviously based in the US. But he has done a lot of work on return on capital and the impact that has on a business, and also the ultimate performance of a business. So a lot of his shorter work that's available freely on the internet. If you search Michael Mauboussin, really some good short pieces that was written.
Excellent. Thanks, Walter. On your side, Cor?
I'm going to be a little bit controversial here. Obviously, we've been through a rough couple of 2 years or so. And I found it very frustrating to listen to mainstream media because you never get the other side. And I've started listening to a guy called Joe Rogan. So, yeah, I've enjoyed his extensive engagements with various people that experts come to talk to him.
Exactly. Yeah, certainly a controversial one, and definitely some cost-free advertising for Spotify. That, Rob, on your side?
I'd say pretty much anything that Michael Lewis has written has been exceptional. Obviously, his writing was shown in the big screen on The Big Short, but Flash Boys is well worth a read if you're interested in the world of high frequency trading. And then in terms of podcasts, if you're looking for a fairly dry but very factual update on markets, Deutsche Bank do good podcasts, but actually if you want something more entertaining and quite still very relevant in terms of economics and behavioral economics and so forth, then the Free Economics guys do a very good podcast, which is often very high quality. So I mean, those are the sorts of things that are usually sticking around in my head.
Excellent. Thanks, Rob. Well, that brings us to the end of the panel discussion. We hope you've enjoyed this riveting session as much as I have. And once again, just thank you to our panelists for joining us today and bringing some insights to your portfolios and your funds. Thank you.
Thank you.
Hello, everybody. Welcome to the new year. So what's been interesting in the world of fixed income? So let's start off, as always, what's happening in the US. Yes, when the US sneezes, the rest of the world gets the cough. It's still like that in 2022. So let's move on to the Fed. Why the Fed? Because it's important. The Fed sets the base rates for the globe. So what is expected? So now we know inflation in the US is quite rampant. Remember, they've got a 2% inflation target, but inflation is running at 7.5%. Wow, even worse than South Africa's inflation at 5.7%. The Fed still rates at around 10 basis points. So what is the market pricing? It's quite clear. It's pricing for higher interest rates. How much? That's where the big debate is. Well, if I look at the market, it says, well, the Fed will have to start hiking rates in March. By how much? 25, 50. We don't know, but rates are going up. How much by the end of the year? Well, we think probably around 1%, but the market is quite worried about this 7.5% inflation in the US. So the market is saying the Fed's quite behind the curve. It actually needs to hike interest rates a lot more and a lot quicker than we all think. So maybe the market says, well, by December, maybe rates will be 1.3, 1.5%. That's a lot. Why is this important? I said to you, remember, a lot of trade in the world goes through dollars. We all need dollars. So when that dollars, the price goes up, we all have to pay more. Are we surprised that interest rates are going up in the rest of the world? Even the European Central Bank. It doesn't want to hike rates. Christine Lagarde says, no, rates are not going up. But if we look at the markets, it says, well, it thinks the ECB will have to hike rates this year by around 25 basis points or 50 basis points. Bank of Japan will have to do something. The Bank of England, it's already hiked rates. It will hike rates more. What are we saying? We've been through a very protracted period of low rates. Think about it, even since 2008. We're moving off it. We're moving to higher interest rates. So over the next 2 to 3 years, tighten your safety belts. High interest rates are coming. That's what markets are pricing. So that's just the short end of the market. So what happens with the bond markets? Are we then surprised when short interest rates move up, that bond yields will move up? And it's not just in the US. Think about it. A year ago, we were talking about 10-year bond yields in the US, probably around 1%. Today, they're trading at 2%. Wow, 1% on 1%, that's a 100% increase just in US rates. A year ago, the German 10-year bond was trading at minus 50 basis points. Now it's trading at nearly plus 50 basis points. Also, a 1% move from very low rates. So it means bond markets are telling us higher interest rates are coming in all parts of developed markets, right? So that's developed markets. So what happens in our favorites? Ourselves. Are we then surprised when emerging market bond rates go up? We've seen strong interest rate hikes from the central banks. Russia, Brazil, Mexico, Poland, ourselves. We were surprised even by the SARB rate hike in November. And then the hike rates again in the January meeting, right? More hikes to come. Bond markets are telling you that. So we are seeing all these emerging bond yields moving up, but the green line is South Africa. Interestingly enough, our bond yields are not rising that fast. Why? We'll get into it. We think there's a bit of an anomaly in the South African bond market. There's opportunity there. But wait, we'll get into that. Right. So if we move to money markets, right, the cash market, the interbank market, where we put our money into money market funds and into bank accounts, what's that saying? It's saying to us, right, the SARB is in this hiking path. We've had the repo rate at 3.5%, and now we're at 4%. Where are we going? Right, tighten your belts, tighten your clients' belts. Interest rates are coming. The market is pricing for about 3% or 300 basis points of rate hikes over the next 2 years, right? Repo rate up to 7%. Do we think that's possible? No, we think the market is overpriced. Why? Because we know that the South African consumer is under pressure. We know there's Eskom tariffs coming. We all know what's happening with the petrol price, right? So we can't afford another 300 basis points of rate hikes. But that's what the market is pricing. But somewhere between where the market is pricing and what we believe the SARB will do is probably where reality will end. So we think the SARB will probably hike interest rates by another 75 basis points, maybe 100 basis points for the balance of 2022. And then probably another 50 basis points odd in 2023. So let's say when the repo gets to 5.5, we think the SARB will probably halt and stop hiking rates. But what's quite important to understand in this whole situation is that, remember, inflation is still 5.7 in South Africa and the repo rate is at 4. The SARB wants to get closer to that inflation number, right? Because it doesn't want to have what we call a negative real repo, a repo rate below inflation. Now remember, they target inflation between 3 and 6%. And the governor said quite clearly to us, he's actually targeting 4.5. So we can work out very quickly that the SARB wants to get to that midpoint. They want to get to 4.5. So we think they'll probably keep on hiking until they get to that 4.5. And then it becomes a bit of a stop-start affair. And then it will probably be a slow rate hiking cycle. But what we are saying is rates go up. If we look at the credit market, and this is quite important because a lot of our funds goes into credit assets. Now, there's a lot of demand in this asset class, and we're only seeing about 100 billion of issuance at the moment. You've got about 1.5 trillion of funds looking for assets in this category, but there's only about 100 billion of issuance. It tells us prices are still very high, yields and spreads are very low. So we're struggling to find opportunity in the credit market, and we say, look, there's issues in this credit market. You can't just buy any spread at any price. We know about the issues around SOEs and defaults in land banks, so be careful when you allocate to credit. But there is opportunities in the credit market, but we are struggling to find good opportunities because pricing is so elevated in this market at the moment, and we foresee that this will continue for a while yet, but it is easing. So let's move over to duration assets, and we start with South African nominal bonds. As you can see, the curve is very steep. So what it means is the short end rates are still very low, let's say around 3.5%, and the long end sits probably closer to 11%. Very steep. So in the world, yield curves are flattening, means the long ends are moving down and the short ends are moving up, right? In South Africa, we still have this very steep curve somewhere between the 3-year point and the 10-year point, right? So we've got this 3 to 10% yields. We think those are good opportunities for South African investors. One of the steepest yield curves in the world. Why? Because of all the negative sentiment. So, when I talk to investors, they always say, yeah, but Eskom this and government bonds that and this and that and the next. That's fine. That's a fair comment. But this already sits in the price. And we always say the best opportunities in markets are when all the negative news are priced, it sits in the yield curve, and we can take an opportunity. And we think this is one of the better opportunities in South African fixed income. Right, so we like nominal bonds. Then we move over to inflation-linked bonds, right? So this is your inflation protection in the bond market, real yields. Once again, you can see the curve very steep, so you're probably sitting around that 1.5 in the front end, and you're sitting around 4% in the long end. In South Africa, we are very used to having very flat real curves. Why? Because the SARB is an inflation targeting bank. They're trying to keep inflation in that 3 to 6 band, meaning inflation in South Africa, we can forecast it and we can build models on it. But now the curve is very steep. Once again, why is the inflation curve steep? Because we're worried about Eskom tariffs, we're worried about administered prices, we're worried about food inflation, fuel inflation. But we say that already sits in the price. We think there's good opportunity here. Once again, that 3-year point to the 10-year point looks very steep in South Africa. Good real yields. This is the asset class. When you worry about South Africa, you worry about the rand, you worry about inflation, this is the asset class that will protect you. And no wonder, last year, when we were worried about inflation, we had this long spike with energy prices. We were always surprised that we had a 15% return from this asset class. No, it came into its own. That's what inflation-linked bonds do, and we still like them. Right, so these are the asset classes. So how do we invest our money? So let's put it into action. How does the funds look? So if you sit on cash and you sit in a bank account, why don't you just put it firstly in a money market fund? So what does the Momentum Money Market Fund look like? Well, it's a cash fund. It's got a very short duration. It's got about 60% in floating rate notes. So as the SARB hikes rates, the yield on your fund will go higher. So it's yielding you about nearly 5%. And remember, if you put your money in a bank call account, it's around 3%. So you get about 1.5%, 2% above bank with good liquidity. And we still like the South African banking system. So why not take money out of your bank account and put it in a money market fund? Good way to make 1.5%, 2% yield without doing much, right? Where it gets more interesting is when we move up the yield curve to credit. Now, this is the Momentum Enhanced Yield Fund, right? So you can see that more than 88% of this fund sits in floating rate notes. What does it mean? SARB hikes rates, the yield goes up. So this fund is yielding you about 6% at the moment. SARB hikes another 50, 75 basis points this year, so hopefully you'll get to a 6.5% yield easily this year. It's got a lot more credit in, of which the bulk of it is in banks. Why banks? Because we think banks in South Africa are safe, good balance sheets, lots of capital, lots of safety, but also corporates. So I know a year ago we all hated REITs and what was happening in the REIT sector, but not all REITs are created equally. We think there are 2 or 3 REITs that's great quality in South Africa. We like to lend money to them. They are great medical companies. They are great retailers. We lend to them. This is typically what you would find in enhanced yield fund. So you get this credit yield uplift above normal money market fund. Yes, we do have a bit of SOEs as well. Once again, there's 700 SOEs. We probably don't like 696 of them. But 4 out of 700, that's our opportunity. That's typically what we do. We like offshore banks, and we do like the South African government. Good opportunities. I think there's decent returns in the credit market for selective investors. Right, let's move to the exciting assets. Flexible income fund. Now, this is our best investment view fund. What's the big question that we always have to ask ourselves? Ian, where do I invest in fixed income? Do I buy bonds or credit or inflation bonds? Your flexible income fund is the fund that answers that question. We as a team, a fixed income team, take the responsibility to give you our best view. So we choose the best fixed income curve in South Africa, and then we go and choose the best point on every curve. Right. So I said to you, we like nominal bonds, we like inflation bonds. So would you be surprised to see the bulk of the asset allocation in the flexible fund to be nominal bonds, inflation bonds, and then those credits that I mentioned to you that we think there's good opportunities. This is a real return fund. So we talked around inflation. So the benchmark of this fund is CPI plus 2. You can go and see that over a 2-year track record now, this fund has returned more than 10%. So a great track record, saying to us that, Ian, you've been on the right curves. Yes, we do get calls wrong, but overall, we've made good decisions for clients in this fund. Right. Now if we move to the real duration assets, bonds. One of our favorite asset classes. So you would not be surprised when you see the Momentum Bond Fund is probably more than 77% in South African nominal bonds. We said to you that curve is very steep. There's opportunity in the 3 to 10-year points on the nominal curve. There's a bit of inflation bonds in here as well. We want some inflation protection in a bond fund, a bit of credit, very little derivatives, lots of liquidity, lots of opportunity in this fund, and we think there's good nominal and real returns from this asset class over the next year. Right, our preferred asset class, inflation bonds. Why? Firstly, I said to you valuation. We are a valuation-based team, right? We said to you that curve is very steep, 4% real yields. I'd have a debate with any investor out there saying to us, this is not good value. If you're a pension fund or a long-term investor, if somebody says to you, we can give you a 4% real return. Now, remember, inflation is probably going to be around 5% for the next year or two. And you get 4% real at a government risk level. That's well done. I'll take it in my own portfolio as well. 4% real yields at low risk plus liquidity. Our preferred asset class. And when we get to the expected returns, you will see the numbers stack up. So what do the numbers look like? So let's put it into perspective. We said to you, inflation this year, next year maybe 4.5%, but this year definitely around 5% inflation. If you're sitting cash, depending on how the SARB hikes interest rates, you're probably going to get 5.5 to 6, maybe 6.5% out of cash funds for doing very little. Credit, a little bit more spread widening in the banking system. So yeah, 6 to 7, that's okay if you're very risk averse. But what gets us excited is that the returns that we can get from nominal and inflation bonds. Now, if you take a very long historical view on South African bonds, you would see that bonds will probably give you around 2.5% real over inflation. So if we say inflation this year is around 5 plus 2.5 is 7.5. But we think inflation bonds and nominal bonds can do better than that. We think there's a high probability that nominal bonds and inflation bonds will probably return around 8.5 to 9.5%, right? Why? Because we think the fundamentals are better in South Africa, and these assets are inherently still cheap on a valuation basis. You don't need to do a lot. These markets don't have to rally hard to give you that type of returns. That's why we say watch this space, be invested. We think there's good returns at a very low risk for our clients in this space. Good luck out there.
To my MFP colleagues, I am sure that you will agree with me that the feedback that we have received from our business partners at Momentum Investment Consulting has been on a level that requires specialist skills, which are different opposed to what we as financial advisors must demonstrate to understand our clients' needs, objectives, and risk profiles. These are two separate skills that we put together to form a best-of-breed solution to our clients. I'm hoping that you will start seeing the benefit of the collaboration between MFP and Momentum Investment Consulting, because it's bringing specialist skills together that will serve our clients' best interest. I'm going to just end off by demonstrating to you how these solutions play out in the minds of our clients, and hopefully you will see how this feedback relates to your communication to your clients. The first is an illustration of how your clients can picture our investment philosophy. This is taking the bucket approach and plugging it into our OBI investment philosophy. In principle, it comes down to if there's a short period, a short term of 3 years, we've got a specific solution for that. If it is a 3-year and longer, 3 to 5 years, we've got a specific solution for that. Longer than 5 years, a separate solution, and then of course the long term, 7 years and longer. If you and your clients can work from this page and this picture, it becomes a lot easier to provide consistent feedback to your client, to remind them about the strategy that you have put together. Our entire investment value proposition is based on this illustration. If you want to use it differently, this is an alternative to position the bucket approach with your clients. It clearly illustrates the first bucket, short term. The second bucket, short to medium term. The third bucket is medium to long term. And the fourth bucket is long term. And we've got separate solutions that is offered within that framework. And then to put it all together, if you use the bucket approach to provide an income at retirement, for example, the first bucket will be the home of your liquid assets, where you can draw an income from. The first bucket provides time for you to see the first 3 years through, and so forth and so forth. That means that picture that you see in front of you, that highlights what Warren Buffett refers to as a free lunch. It is a diversification of investment risk. And that together provides a holistic solution which you can present to your client with the utmost of confidence. Colleagues, to summarize, we've had feedback from our investment specialists. We have seen that about a third of our investment advisors have adopted the MFP House View solutions. That is extremely exciting for all of us, because you would have seen in our feedback, fortunately markets have helped us over the last a few months, which has given us very positive feedback. But our portfolios are structured in such a way that it should provide the outcomes that we have presented to our clients, on condition that we stick to this strategy. I'm hoping that you are filled with confidence to use these solutions, because it is well thought through, it is stress tested, as we said, and We are absolutely sold to provide you with the best possible long-term solutions for your clients. Thank you again for joining us. It was a pleasure hosting you.